Hi, everyone, and welcome to the latest Trivium China Flash Talk. I am Andrew Polk, co-founder and head of markets research at Trivium China, or I guess sort of former head. We're trying to figure out what these titles are. Dinny McMahon is joining me today, who's our new head of markets research. We're tag teaming this for now, but welcome, Dinny. As always, great to have you to chat through the latest on China's economy.
Great to be here as always, Andrew.
For those of you out there who are listening, just as a little bit of housekeeping, we are going to start doing these on a biweekly basis. Dinny and I are going to go through sort of the latest themes that we see in terms of what matters for China's economy. We will be playing around with the format a little bit. We may do some live. We would like for these to become interactive, obviously on sort of a biweekly, i.e. fortnightly basis. There's only so many discrete new developments that happen. So, we will certainly keep them timely, but we want to make sure as we do these that we're kind of moving the ball down the field analytically for clients as we go. So anyway, all that to say, it's a bit of a new effort for us. But we hope you enjoy them. We're going to keep them tight, keep them quick, 30 minutes or less, especially in our live ones. We'll do 10 minutes of my presentation, 10 minutes of Denny, then we'll do 10 minutes of questions. But today we'll look to go 20, 30 minutes just back and forth since this is recorded. Today we're going to talk a little bit about both the consumer outlook and again, property. As I said, with these fortnightly presentations, not a ton changes every 2 weeks. And so for now, property really remains a key theme in the growth outlook. I mean, that's green. That's an evergreen statement for China. But in particular, right now, given what such a difficult year the property market in China had last year, the outlook remains particularly important. So let's jump in. I'm gonna kick off with a few thoughts, and then Denny and I will go back and forth a bit. But I think what I've been saying to clients, Dinny and I have been doing a lot of client calls these first few weeks of January. Dinny, my theme has been don't overthink it. You've heard me say that to lots of clients, just, that with the point being, I think a lot of people are trying to think about where the pitfalls for China's economy, what might we not be thinking about that could disrupt economic growth. But at the end of the day, like this narrative is pretty constructive. And the consensus around China, now that COVID zero has been dismantled, is a bullish case for, at least 2023. And my view, again, is not overthink it. Any economy coming out of the pandemic tends to perform pretty well. And China is likely to be no exception. And I dial back to, late spring and into summer 2020. China very quickly got on the backside of the early part of the pandemic while the rest of the world was shutting down in various states of shutdown as the initial wave of the pandemic spread throughout the globe. And one of the most crowded trades in the world was long Chinese assets, particularly CNY versus USD. And everyone knew that China was outperforming. It was very quickly resuming normalized activity in the industrial space, just as everyone else was kind of hunkering down. And it seems like we may be not just seems like, it seems quite clear that we're in one of those moments again. China is coming out of the pandemic. The rest of the world is seeing, tightening policy, particularly on the monetary side. And, people are worried about global recession. So as particularly in the developed world. And so again, our thinking as we start 2023 is don't overthink it. China is likely to have a good year economically, and that should translate into into strong performance for Chinese assets and Chinese linked assets as well. For us, we just wrote a note last week on the back of the December data, which actually came out even better than we expected. And I think our thinking now is really less about will China's economy normalize or perform strongly as we exit the pandemic, and rather how long or sustainable will the recovery be? We actually think, based on some of the data out of December, that the economy is going to normalize more quickly than we had previous thought, and a lot of people had previously thought. I think most people were zeroing in on Q2 for the stabilization of the economy, but it seems like actually based on some of the improvement in consumer spending, for example, industrial production, that we could see a very quick normalization post Chinese New Year. So even kind of late February, early March, so late Q1 timeframe. And I think we'll still be monitoring that data to see if that continues in the weeks ahead, and we'll be talking through those data points on these talks. But I think one of the things, and I think we mentioned on our last webcast, was that that's been surprising is just how quickly most Chinese people, it seems, anecdotally, have acclimated to the post zero COVID climate. And what I mean by that is, everyone was told to be scared of the virus for years and years and years in China. There wasn't much virus, and now there's virus everywhere. And just like in most places, what's happening is people are contracting the virus. The vast majority of people are recovering from the virus quite quickly. And then they're thinking, okay, that's not a big deal. I want to get on about my life. And so that seems to be, having a positive impact, on the mentality of individuals, on the overall economy, and obviously on confidence. Let me go through just a few of the things here before we dive into a little bit of the consumer piece. So in December, retail sales fell 1.8% year on year. That's compared to what was expected to be a 9% drop because of the widespread outbreak in some big cities like Beijing and Shanghai, and still some lockdown measures in December. Most analysts were expecting further retrenchment in consumer spending and retail sales. There was a 5.8% contraction in November, so it was expected to contract further to 9%, but actually we saw 1.8, just a 1.8% contraction. Still not anywhere near what you'd want in terms of normalization, but certainly an improvement. Part of that was down to a couple of quirks. Medicine and drug sales were up 46% year over year in December, as people were trying to get out there and get painkillers and cold medicine to help get through the COVID outbreak. So that certainly drove some consumption, and auto sales were up pretty strongly at 4.6%. And that was partly because some auto purchase subsidies were expiring at the end of 2022. So that was a little bit of a manufactured fillip in spending, but still doesn't explain all of the improvement, especially when the full expectations were for a more market retrenchment in spending. So even in December, with all the chaos of the COVID outbreak and the dismantling of zero COVID, consumers started to show some positive signs. And even, if you want to really read the tea leaves, the MBS's services production index improved year-over-year growth in December as well. It went to just barely negative year-over-year, and so from about 2% negative or 2% contraction in November. Again, not a massive improvement, but still trending in the right direction, leading us to believe that maybe things are improving even more quickly than we expected in terms of the services sector, consumer mentality, people's willingness to get out their wallets. So the big question here, again, I would say is, so the big question is, how strong will consumers come back? I would say, again, the theme, don't overthink it. Almost everywhere in the world on the back of the pandemic, consumers come back pretty strongly. And so I think should be the base case. Now, the question then becomes, to what degree? Are there things holding the consumer back? And so the one data point that people point to is there's 18 trillion new renminbi in household savings that were added in 2022. So people were, stocking up their savings during the volatility and the outbreaks of 2022. So in theory, there's strong balance sheets and people may be ready to spend. But as Dinny, I'll throw to you now, Dinny, you pointed out just before we were getting on, that there's some caveats here, that Chinese consumers experienced COVID differently, particularly over this past year, than people in other economies. So while they have the strong balance sheets, maybe there's a couple of things that we should take note of to temper our optimism on just how strongly consumers are going to come back. What's your thinking there?
Yeah, absolutely. I mean, China, the experience of Chinese households of the pandemic were very different from those in, say, Europe or the United States, because in large part because there weren't the stimulus checks that were going to households. So, the stimulus checks that went to households in the United States, for example, that allowed people to set up their own home offices and do home renovations. It allowed people to pay down debt, which was incredibly important because that kind of alleviated some of the financial pressures on households. And it allowed a whole lot of young millennials to take the money, and they didn't have better use for it, and trade it on Robinhood. None of those forces, none of those factors were at play in China. The Chinese households were very much left to themselves, and they were dealing with real pressures. There was real unemployment in China, particularly, and still is, particularly among youth, which I think the rate got up to almost 20%. Secondly, people were genuinely concerned about losing their jobs. And there was a lot of people's income was declining, because in China, a lot of people's income kind of comes as bonuses and cash subsidies and whatnot. That sort of stuff started to dry up during the pandemic. And so people weren't as well off financially as they had been previously. And of course, sort of income increases, wage growth kind of stalled out as well. And particularly for people in large cities who are dealing with large mortgages relative to the size of their income. One of the things that makes those mortgages sustainable is because wage growth in China has consistently been reasonably strong for years. And so year in, year out, the relative burden of their mortgages declines, and that stalled during the pandemic as well. So when you listen to Chinese economists, they have an expression for what some of the savings that was going on over the last few years was. They're saying, well, this was, the balance sheet of Chinese households were damaged. And the first thing that Chinese households prioritized was repairing their balance sheets. I think that's a lot of what was going on. Now, of course, at the same time, this 18 trillion renminbi increase that Andrew was talking about, which was effectively almost double the increase in 2020. Some of that, rather than just repairing balance sheets, a lot of that was also just people being more conservative with the way that they invested money. It was funds that did not end up in the stock market, and so ended up as deposits in the bank. It was also the decline in the purchase of new houses. And so money that people have been saving for years, which would usually have gone towards a down payment on a new product built by a developer, that wasn't getting spent either. So you kind of put all this together, and there was a whole lot of sort of structural factors for why these savings have massively increased, rather than people just not having anything to spend it on and saving it up for a rainy day. Now, you take all of that, and that says that there isn't 18 trillion renminbi sitting there that people are just itching to spend. However, what Andrew said still completely stands. This is people coming out of the pandemic, and they just want their lives back, and they want to spend. And anecdotally, we hear that the restaurants in Beijing are full. You're hearing that people are, the visa offices of embassies in Beijing are full. People just want to get out and get their lives back and catch up on lost time and spend. And that is what we're going to see, even if 18 trillion renminbi isn't about to sort of flow out of people's household savings.
Yeah. Yes.
There is that pent-up demand to spend, and it's going to provide a real boost.
Yeah, that's really good color. I mean, I think, it really is, again, I don't want to hit it too hard, but don't overthink it. People have money, they want to spend. Like we see it, as you say, anecdotally, we talk to people in China every day. Also, just, people in China are much like people anywhere else in the world. They've been pent up, they want their lives back. And so that spending is going to happen. But there are some important caveats. I think that's a great point, that whereas in the West, much of the balance sheet, movement among households was sort of bolstering balance sheets, bolstering already relatively strong balance sheets, and or this idea like, we don't have anything to spend on anyway. Why? I'm not going to go out to the restaurant, or I don't really want to buy the new car at the moment, or whatever it was. Just didn't have an opportunity to spend, and were bolstering balance sheets. Whereas as you're saying, that in the Chinese context, it was more of repairing already somewhat damaged balance sheets. That's an important context, which, as you say, doesn't mean that 18 trillion isn't 18 trillion of money to be sent out the door. Maybe it's 10 trillion, maybe it's 12 trillion. That delta makes a big difference. But again, we know the direction of travel. The other thing, just to put some data points around what you said. So real income growth in 2022 was 3%. That's the lowest in years. It's the same as it was in 2020, but that also with a slight increase in 2021 because of some pandemic weirdness, obviously. But point is, income growth was very low last year and kind of has been low. That's compared to 8% growth in 2013 and about 6% growth in 2019, just before the pandemic. So throughout the pandemic, effectively income growth halved. And so not only is some of the savings repairing balance sheets, but also very clearly some of the savings is precautionary. So it's not like we're just building it up so that we can go take the vacation. It's we're building it up in case, my mortgage relative to my income, becomes more expensive, or I have a medical emergency, or I have some other family emergency, et cetera. And then also we're seeing from official data that people's expectations of their future income are the index that tracks that is at a historical low as well. So people's forward-looking thinking around what their income and finances will look like has deteriorated as well. All that is to say, there are certainly caveats, and I think investors will be thinking about, okay, where are the holes in the China story at the moment? And these are certainly some headwinds to think about. But fundamentally, people are going to get out those wallets. We're already seeing it. So it's a matter of to what degree. Now, our thinking here is so that's kind of the broad thinking around the consumer. The question for us is kind of what fills the gap between COVID relaxation and a real takeoff in consumption, which the takeoff in consumption would be the thing rather than driving the rebound per se, would be the thing that gives the rebound legs. How long does the rebound in growth carry into 2023 or into 2024? Do consumers come back and do the one-off vacation and say, I got it out of my system? Or are they, re-engaging in consumer habits and consumer life more generally? And so our thinking is, there's going to have to be a handoff. You're going to get a kind of automatic pop to confidence and activity with the dismantling of COVID after we get through, the dismantling of COVID zero, after we get through the initial chaos. Looks, as we said, like we're getting through that initial chaos quickly and should normalize fairly soon after Chinese New Year. But the question for us is what kind of sustains economic activity for, say, a quarter or so to further consolidate the improvement in business and consumer confidence so that they can continue to spend both on the business capex side and the consumer side. You look at the national income accounts, and there's only a few areas of growth to really look at. Obviously, exports are not going to do it. We're not going to get a fill up on growth from exports because the rest of the world is having cost of living issues and looking at staring down the barrel of a potential global recession, as we said. So exports pretty much off the table. Government spending also seems largely off the table in terms of a big bang new revenue. The budget, deficit was fairly large last year. There's not a ton of room to expand it. Also, they bolstered, central government spending with some one-off tricks, 1 trillion renminbi, transferred from the PBOC and the state tobacco arm or whatever it was. So, that was a bunch of money that was spent through the central government. That was kind of a one-off piece. And then special purpose bonds, the other big piece of the fiscal pie, was already very large last year. I think the quota was 3.65 trillion, but 4.15 trillion was issued because there was leftovers from 2021. So we don't expect, we expect the reporting is that the quota for this year will be 3.8 trillion, which is higher than last year's quota, but lower than last year's overall issuance. So again, doesn't seem, while there's some space for fiscal support, we don't think that the government spending piece is the thing that carries the baton. So that basically leaves the other elements of domestic demand, which is kind of infrastructure, or excuse me, investment spending. So which, if we break down the investment spending profile, we can look at the areas that could potentially carry through the consumer the economic momentum from the dismantling of zero COVID to fill the space and bolster confidence among households and businesses till we can get that sustainable services and consumer sector push. And in investment, there's three main areas, right? There's infrastructure, which I think is just shy of 20% of spending; property, which is typically just over 20% of spending of investment spending, 20 to 25, I believe. And then manufacturing, which is about 35% usually on investment spending. Well, if we break these down, infrastructure, kind of linked to the government spending space, doesn't have a lot of room to improve. We saw 11.5% year over year growth in infrastructure spending last year as the government tried to do an infrastructure stimulus in the absence of property stimulus. That's the highest infrastructure investment growth since 2017. So not a lot of extra fuel you can add to that fire. That a lot of that was linked to the SBP special purpose bond story that I just walked through. So, we know that special purpose bonds are likely going to pull back a little bit. That financed a lot of the infrastructure spending. Already, infrastructure spending was very aggressive in terms of year over year growth. So hard to see a bunch of new growth from there. And then we go to the other big chunk, which is manufacturing. Manufacturing capex, what grew at 9.1% last year. Also very, almost 10%, very aggressive, just shy of the 11.5% in infrastructure spending and above the 5.1% overall FAI spending last year. So it's clearly infrastructure and manufacturing that were driving investment spending, while the other big chunk, property, was in the doldrums last year. And so again, it's hard to see how, especially private sector companies, but even state-linked companies, keep pushing the manufacturing investment further and further and further above this already pretty aggressive 9.1% growth. So even if they kind of maintain their levels of spending, that growth will come down just on base effects. So that's two big chunks. That's about 50% of investment spending that will maintain decent levels, but on a growth standpoint, really won't push us or sustain us from the zero COVID opening into a more consumer and services-led sustainable recovery. What does that leave? Property. We've been looking at property. Dinny's been talking about property. Obviously, property was terrible last year. So it kind of comes down, as it often does, to what is the performance of the property sector going to look like. And here, I'll go ahead and throw to Dinny. Dinny, talk to us about, we've talked about property last 2 weeks ago. What's the latest on property? Any updated thinking on, we've talked about the pre-sales model that could push investment up ahead of resumption in property sector demand. Any of your latest thinking? Where are we at? What's new, and what's your level of confidence that property can carry us through?
Right. So for property to really start contributing to growth again this year, either demand has to recover, and we're still not seeing any sign of that. But of course, that's partly because COVID has been so rife, and now we're into Chinese New Year. We'll probably get a better sense in the next couple of months if there's any changes there. And alternatively, for construction to start rising in lieu of an increase in housing demand, because they changed the funding model and do away with pre-sales, as we talked about a couple of weeks ago, and as we've written about. Again, we don't have any indication yet as to whether we're moving in that direction, but whether we're sort of on the lookout for it. So far, the only sort of changes to property policy is additional support that was flagged a couple of weeks ago by a PBOC official at a press conference, who said that they're rolling out a 21-point plan to provide support to healthy developers. Now, to call it a 21-point plan, it's not quite a 21-point plan. It's kind of, 21 metrics and tasks and whatnot. He was incredibly vague about what this thing looks like, but the idea is that they will recognize what put together a bunch of parameters that will define what a healthy, well-run developer looks like, and it will then fall upon financial institutions to provide them sufficient support. Now, the only real tangible support measures that he really talked about was, one, there will be a new re-lending facility to lend cheap credit to the asset management corporation. So these are the bad banks, Huarong, Xinda, Great Wall, and China Orient. And that there will be a new loan support program to help with the development of rental housing. And this is kind of a key sort of top level property support or property overhaul measure. This goes beyond deleveraging. This is very much about trying to reduce the cost of housing by ensuring that there is a sufficient supply of good quality housing in places where it's needed, that people can rent. So at the moment, I mean, it's a problem throughout China, but particularly in the major cities, is that there's just a dearth of quality rental housing. And so people, particularly young recent university grads and migrants from the countryside, they end up living in dormitories, which doesn't sound so bad. But I know when I was living in Beijing, right next door to the bar district, I was living next door to an apartment which was as equally as tiny as my own, but it was a dormitory. I mean, there was two rotating shifts of people who were sleeping in there. I think there were kind of like 6 to 8 at any given point in time. And big cities are dotted around with things like that because people cannot afford accommodation. Urban slums. It's something that you stumble across when you're walking through Chinese cities. We're not talking about things like Rio de Janeiro or sort of outside of cities in South Africa. They're almost postage stamp size, but they are everywhere. And then, of course, if you're a construction worker in China, you typically live on site because there just isn't enough cheap accommodation to rent. And that's a big part of Xi Jinping's vision. And so there will be new funding available from the central government to ensure that more of this sort of housing comes into being. And also with the AMCs, what the focus of this seems to be is, again, it's about helping distressed developers sell off their assets. What we're assuming is going to happen is that the relending facility will provide cheap credit to it will provide cheap credit to the AMCs, which will then allow them to be able to purchase assets from distressed developers. That's what we assume it's going to look like, but we still need to get details. The long and the short of it is clearly the focus of Beijing at the moment is still on trying to preserve what is worth rescuing of the property sector, of the developers, which is something they've been doing pretty much in force since October, but even since then. But that's very much been the core of property measures over the last few months. But that doesn't fix the bigger picture, which is how do you get construction going again in such that it can meaningfully contribute to growth, and or how do you resuscitate demand? Those are the things we've really got to look for in the next couple of months. But as yet, we're not getting clear signals.
Yeah, and I think, I mean, exactly right. So that's where we are. In turn is like, basically, we need property to come back, but it's still a big question mark in terms of overall construction activity. Again, I think we made the case we don't necessarily need the demand side to resume if the funding model starts to change, but property construction now becomes very important. I'd say the key variable in kind of late Q1 into Q2, again, for a handoff of economic activity on the back of kind of this pop from exit from zero COVID towards where the consumer can really and services can really carry the economy forward. I'd say, so just tying this off, we're close to the 30-minute mark, Dinny. That was great. Do you buy, so that, as I said, the consensus is very positive at this point. And I think, for listeners who've known us for a while, or clients who've known us for a while, we're not particularly bullish. Well, we're not particularly bullish or bearish. We try to really, call it like we see it. But if we're one or the other, we're probably slightly bearish in terms of China's long-term, growth prospects and the challenges the economy faces, those kinds of things. But personally, I'm pretty bullish in these next, 2, 3 quarters. I mean, for like I said, the obvious reasons and the kind of mantra of don't overthink it. Am I being too optimistic? What do you think? Where do you think we are, and where do you think, is the holes in that narrative maybe?
Um, I look, I broadly agree. It does depend a lot on what they manage to eke out of property. I mean, even if they start to change the model and they push construction ahead of demand, it's a question of when they start to do it and how aggressively they do it. I mean, the way that things work in China is when they roll out a new approach, a new approach to, well, new policies, economic policies, financial sector policies, regardless. They usually do it on a trial basis first. They do it slowly, then they ramp up. So even if they start trying to do this in the first quarter, it's going to take a bit of time before it really, picks up momentum. But yeah, I think in the short term, we'll see a pop in consumption, but those other moving parts of the economy, I mean, for me, it's a big moving
Difficult to
part is
say.
property, and it's still a head scratcher at the moment. It can kind of see what
Yeah.
they can do and what they could potentially try to do, and what sort of time frame they might be able to roll it out over. But
Yeah.
it depends. We're just not sure whether they're going to do it yet or not.
Yeah, no, well, I mean, I think a lot of this comes down to sort of activity versus growth. What I mean is, as I went through, infrastructure is going to remain strong. It's just hard to get more growth out of that per se in terms of base effects. Manufacturing and industry also going to remain strong, right? They've remained strong throughout the pandemic, right? Because especially on the industry side, the government has these levers to pull with the SOEs to say, you guys keep producing no matter what, do closed loop, whatever it is. So industry will be strong. I think manufacturing remains strong even despite external slowdown, global slowdown. It's just harder to get growth out of there. So now we're looking, where does the growth come from? Clearly, there's opportunity in the consumer and services and travel and things like that space. The other big growth opportunity is property because of just how just terrible property performance was last year. So even if they kind of right the ship a little bit, you're looking at potentially some decent growth numbers. Even if you get into single digit positive territory year over year in terms of activity, it's much better than the -10%, -15% we saw last year. So I think that's kind of where my head's at. But we'll see, and we'll be tracking this closely. Again, we'll be doing these updates every couple of weeks. Please send through your questions, follow up with us. We're happy to do, one-on-ones with any of our clients, of course, anytime. So please just email us and we'll do some of these live as well. Any last comments there, Dinny, before we sign off?
No, I'm good, mate.
All right, we covered it. Okay. Well, thanks everybody for listening. We'll be back in a couple of weeks. We appreciate the time and have a good one. Take care, Denny.
Thank you.
Bye.